In the middle of Corona, where we can all kind of sit together so close and not be afraid. Murray, it's too late now. The damage is done. You can stay close to it. Thank you to Graham for the presence of the Australian Chamber of Commerce. We were waiting for the American Chamber of Commerce and the French Chamber of Commerce. They're probably stuck in traffic. EDB is missing still. Oh, sorry, EDB, thank you. Sorry, Shakil. SA High Commission, we're looking for Shakil. Thank you for your presence. Guys, so today is like my inaugural speech. So being the first day as President of the South African Chamber of Commerce, I'd just like to thank Richard. After watching the inaugural speech of Biden last night, we have to, really appreciate it when the outgoing president attends your event. So Richard, thank you for your support, Richard. Richard, you've accomplished what Trump was trying so hard to do. 8 years in office as president of the South African Chamber of Commerce. Richard, thank you so much for your service over the years. Thank you for building the Chamber of Commerce from an idea into the collective voice of the South African community and investment in Mauritius. So thank you, Richard. Nothing fancy, just for your rights to the shop. Thank you very much. Thank you. Thank you, everybody. I'm delighted to still have Richard on the board of the SA Chamber of Commerce, so I can chat with all that lovely wisdom and grey hair. We continue to have a strong board supported by my partner in crime, or my partner in vice, Sean Thompson, the Vice President of the SA Chamber for this year. The SA Chamber remains the core goal of promoting trade and investment between South Africa and Mauritius. We remain an open chamber and we welcome members that are South African, Mauritian, or whichever country you come from, as long as you share the common ethos and will benefit from the chamber. We uphold our values of sustainable development and looking after the planet that protects us. At the chamber, we believe our key to success is information, timely, adaptability to change, and having key networks. With that in mind, with the key information in mind, I'd like to thank our sponsor, Sanlam Group, represented by Sanlam Trustees, Sanlam General Insurance, and Sanlam Private Wealth. So, Mark Muller, I'd like to please welcome you to introduce the Sanlam Group and Arthur Kemp, our speaker for today.
Thanks, Bilal. I've been given strict instruction by Francesca not to move the camera on here. Thank you very much for attending, and we're very privileged to. I think this is the third year. Where's Richard? Richard's. I think it's the third year that we're sponsoring the first event of the year. We were joking last night that we got an obscure question last year about the virus in Wuhan, and as it turns out, it wasn't such an obscure question. So let's see. Any obscure questions, we'll take careful note of them this year on. Just a quick note on Sanlam. The Sanlam Group in Mauritius is made up of a number of businesses. I look after the private wealth business, and we've got Sanlam Trustees. Tom's here as well. I did see Tom earlier. There's Tom. And then Didier looks after the Sanlam General Insurance. Didier sitting just there behind Tom. So as a Sanlam Group, we've invested heavily in Mauritius, and part of that is wonderful to be involved with the SA Chamber. I don't want to delay the matter any further. We've got this morning, we've got a couple of countries that are dialing in as well. You'll see that on the screen there. So very fortunate that we've got counterparties and clients all over Africa that are dialing in. I think we've got 6 countries that are dialing in. Some of them quite early in the morning for them. Some of them are going to watch it on recording. So you are officially now the live studio audience as well. So please keep, and there are microphones around the room. So for anyone passing rude comments and things like that, just be careful. We will pick you up and we'll take careful note of where you're sitting as well. Arthur Kemp is our chief economist. It's been my privilege over the course of my stay at Sanlam so far to have worked with Arthur on a number of occasions. Arthur is the go-to on anything relating to the future of where the global economy is going. Arthur has spoken at a number of our events that we've held in Africa, investor conferences in Lusaka, Nairobi, Accra, etc. And he's always come much appreciated by our audience. So I'm sure that this morning is going to be no different. In fact, Arthur took us through a warm-up yesterday. And where's Bilal? Bilal was asking a page full of questions, so you can perhaps reserve those for the end. But just a quick bio on Arthur. Arthur, as I said, is the Sanlam chief economist. He has a wealth of experience. He's worked for more than 20 years in the investment industry. Arthur holds a B Econ, Economics cum laude degree from the University of Stellenbosch in South Africa, and a master's in financial economics from the University of London. So Arthur, if you can hear us, I think this is your cue to start speaking. Francesca, have you got Arthur on?
Good morning, everyone. Hopefully you can hear me. How does that sound?
Yeah, it sounds good.
Okay, and I'm sharing screen. So is the presentation up? Okay, can you guys see?
Got you. Second page, Arthur.
Okay, is that flipping through? Can I carry on, guys?
Yes, that's fine.
Okay, sorry about that. So that's what happens when you invite an old dinosaur like me to breakfast and you add technology into the mix. So thank you so much for asking me to have a chat with you this morning. And that's how we'd like to keep it, as a chat. So, I'll try at the end to answer any questions you may have. But in the interim, okay, so why are we here today? We're having a look forward, always a very dangerous thing to do, to forecast the future. As we saw early last year, if one had an outlook for 2020, and you compare that outlook that one had in January to what we eventually got through the year, it's two very different things. And so we must understand that the world is heavily impacted, and it seems increasingly more so by random events. And we need to recognize that happens, but at the same time, try and figure out, stand back and say, what are the underlying themes in the global economy that are likely to endure and impact us in our daily lives as businesses and as investors in financial assets? Okay, so slide one, it just looks extraordinary, right? So this is just a year-on-year change in real GDP for some countries around the world. And, this slide goes back to 2007, and one can see just how absolutely extraordinary this is. Two things are extraordinary. One is the extent of the fall and the suddenness of the fall, and the second one is the snapback and how sharp that has been, led by China and obviously followed by other countries around the world. Now, we'll get back to this, but there's one thing that this chart is not showing. I mean, this looks like we've recovered back to normal, right? But that's not the case. We know that the recoveries are incomplete, except, for example, in some countries like China where economic activity in the third quarter of last year was already back at pre-pandemic levels. But I think a number of countries, and especially in emerging markets, we're going to take a little bit of time to get back to where we were. The good news, of course, is that we are now looking up rather than looking down. So it's been the snapback in the global economy, and at the same time, very simple, straightforward chart, Standard & Poor's 500, equity market, US. I mean, this is just extraordinary, right? If you think back to where we were in March last year and where we are now, I wonder how many of us would have expected the equity market to finish 2020 where it has compared to where we were when the pandemic first hit. So I want us to ask, how did this happen? How did the snapback happen, and why are markets so buoyant? So the first thing was we got a huge policy response. I mean, there's no doubt about it. I mean, if you take together monetary policy and the fiscal policy response, it is something quite extraordinary. In fact, it's the second time it's happened within the space of not too many years. You'll remember the global financial crisis. And certainly that lent support. The second thing, and we get back to this in a short while, is I've seen through last year a growing optimism that if we can get a vaccine rollout going, that would be a game changer. Okay, so just on the, just the size and scale of fiscal and monetary policy intervention. So first of all, the central banks. And I can show you lots of charts about the size of central bank balance sheets and their assets, and we know that they're very, very large, and there's no surprise that the Bank of Japan, the ECB, the Federal Reserve, Bank of England, all continued with very large purchase programs, buying assets, not just government bonds, but a lot of support for businesses, both directly and indirectly. Really extraordinary use of balance sheets. Justified? Yes. When you're faced with something like the global financial crisis, and when you're faced with something like the pandemic, the first port of call is the central bank, because one of the central bank's key tasks is to maintain financial stability. And if you've got two bad alternatives, the one is use of a balance sheet that might have some implications down the line in terms of, for example, inflation or depression. You choose the former, right? It's pretty much a no-brainer. But the thing that was interesting about this round as well is that emerging markets too have used their central bank balance sheets more aggressively, some far more reticent than others. And one of the key issues, and I'm not going to delve into it right now, we can make a couple of points in a short while. But there's this fear that we could have an inflationary response or irresponsible government spending if the central bank were to be too lenient on its balance sheet. But the point being that a lot of emerging market central banks, even if it was only to provide liquidity and calm markets down, certainly got involved, and it was the right thing to do. But you can see here on this chart that just shows you the percentage of marketable securities of debt that were issued since last year. This is data up to October from the IMF, and the percentage of that debt that was bought up by central banks. So, in some cases, above 50%. The other thing, of course, was fiscal policy. So I'm not going to show you a lot of charts about budget deficits and developed markets, but we know that there was a lot of income support and a lot of spending. Again, faced with two bad alternatives, you end up with a very high debt level, and all the implications that has in the If we look at the US, for example, and I think this is a fair illustration of it being successful, and that is just let's look at the household savings levels in the US and how that has spiked upwards. So this is pretty much, money sitting in people's savings accounts and could find its way back into the economy in the year ahead. It's one of the reasons why one expects developed markets. This is not just in the US, it's in Europe as well. And the argument has been made, this isn't precautionary saving, which is the first thing that you'd expect, but perhaps also involuntary, which means that as economies normalize and people can move around more freely again and spend on what they want to spend on, then we'll find that helps the economy. But the thing was that also in emerging markets, in some countries we got an enormous fiscal response. So there are two channels here. The one is the direct budget. Okay, so first of all, we know they're automatic stabilizers in the sense that revenue falls. So you get a big budget deficit, but also countries spending more. But what has also been very evident this time around, also in DM and here in emerging markets, is the use of alternative means of support. Equity injections, loans, guarantees on loans, and that's the orange bars, right? So if you add that in, some of the fiscal support in some of these countries was particularly quite impressive, in fact. So we can chat about what Mauritius, which is clearly made extensive use of those sort of alternative means. But then also countries like Peru, Poland, and South Africa in particular as well. So a lot of support. So governments did the right thing. And the whole thing about COVID was that you needed to bridge the gap between the pre-COVID world and hopefully what will be in time a post-COVID world. And that is provide income support, keep credit lines open, and then also protect balance of payments positions. And in some countries, EM countries, of course, borrowed quite significantly from the IMF and helped to stabilize the balance of payments and economies. All right, so so where are we relative to a year ago? And I can show you a lot of charts on consumption and fixed investment and sort of normal stuff you see, but let's look at something different. So you know that Google is tracking you, right? Google knows where you are. from those Google mobility reports are put together. And what this chart shows you here is the blue dots is the deviation, the percentage decline in footfall through grocery and pharmaceutical stores for different countries relative to a baseline. And the baseline was the period before the pandemic, January the 3rd to February the 6th is what Google is using here. And then the orange bar is the percentage deviation from that baseline. So one can see those blue dots, quite extraordinary falls. One can see Mauritius there, one of the sharpest declines across our continent. But in a number of countries, we are now well above pre-pandemic levels. Cote d'Ivoire, Morocco, Ghana, Botswana, footfall through grocery pharmaceutical stores up. So there's been a recovery, in some cases, though not complete. Same with workplaces. Interestingly enough, you'll see there Mauritius, footfall through workplaces is back to pre-pandemic levels after also being one of the sharpest declines. And across the board on our continent, you can see significant improvement. Some countries, not so much. For example, Mozambique. And in some countries, there is still quite a wide gap, obviously, between where we were and where we are now. And those at the end there, one can see Zimbabwe, South Africa, Malaysia in Asia, Rwanda, Zambia, are still countries in Namibia that have a significant decline in footfall through workplaces. But it's very difficult here to figure out to what extent this indicates shutting down of businesses and to what extent it actually indicates working from home. I think the latter is quite significant. Okay, so we've snapped back. The recovery is complete, but we're looking up and we're looking forward. And I think most forecasters are looking for good positive growth of obviously a very depressed pace in 2021, but it should feel better compared to clearly what we saw last year. But is there reason to worry? There's always reason to worry when you're an economist. And one of those reasons is, of course, the renewed spike that we've seen in infection. So this chart simply shows the blue line is new daily cases across the world per million people. And one can see the significant pickup there. Seemed to be trending down late last year and then pick up, and that could perhaps be the new variant, for example, the one we have in South Africa, where the disease has become more transmissible more quickly. And then the orange line is a stringency index. Now, this is put together by the Blavatnik School of Government, University of Oxford, and it's an index that gives you an idea of how strict the economic containment measures are that are restricting the behavior and movement of people. There's a lot of things that go into it, anything from the health response to the closure of schools, to cancellation of events, shutdown of workplace, all these things put together in an index. So it's just indicative, and the trend is probably more important than the absolute level, because of course this is very difficult to measure. But I think this is a very good indicator, and of course 100 would be maximum. And so we can see there when the pandemic broke out, the reaction. And since then, it's eased off. And the one thing, yes, it's picked up a bit again of late. We've seen the renewed restrictions, but it still remains below where we were at the height of the pandemic. So at least that's a plus. But nonetheless, as President Biden said last night, this disease is now in a very dangerous phase. In Africa as well, if we look at our continent, so we know that the infection rate's very, very high in South Africa, also very significantly high in countries like Namibia. Hopefully, we've peaked on the second wave. We see that Morocco seems to have peaked a bit earlier, around about November, and starting to come down. But there are some countries where it's lifting a bit. And of course, we know that with Corona, you can't, when it gets a foothold and starts to spread it can be devastating. And we see there's Zimbabwe and Zambia picking up a little bit. But the thing to note here is that across the board in Africa, infection rates on aggregate have been a lot lower as percentage of the population compared to, for example, developed markets like the US and the UK. If I had to put them on this chart, you're looking at 800 to 900 infections per million people per day. These are daily infections. Okay, so, that's one reason to worry is, and I'll get back to it because, it's clearly also related to the issue of vaccines. The other reason, of course, to worry is that we have an incomplete recovery. And always lurking in the background is the risk that households and businesses may not be able to repay loans, put pressure on the financial system with a negative feedback loop. And we know that some industries have been particularly hard hit. So yeah, I've just shown you, and that industry, we know it's tourism, and we know a lot of services industry, entertainment, these types of industries, and it's no secret. But the extent of it, is still particularly worrying. So if we look here at tourist arrivals, it's a blue line, literally it went to zero. So I'm just showing Mauritius here. And then off the right-hand axis, the orange line is reading gross tourism earnings in rupee, rupee millions. And literally from where we were, it's depressed. And I think the concern is how long is this going to take to pick up again? It might be a good couple of years before we see tourism return to its pre-pandemic levels. In South Africa's case, just as another example, I'm just showing you restaurant income here from Statistics South Africa. And you can see in year-on-year terms, very depressed. It's quite a disappointing result. We opened up our economy for travel between provinces in the third quarter and in the final quarter of the year. And towards the end of the year, we opened up for international tourism. Yes, there's been a bit of an improvement in year-on-year terms, but it has been disappointing relative to what one would have expected. And in my opinion, I think the tourism industry is probably in the near term going to increasingly focus on regional tourism before we're going to see quite a sharp pickup again from foreign tourism over time. So incomplete recovery, that's always something to worry about. There are businesses under pressure, and that's not going to end anytime soon. And then we also know the balance of payments. A lot of countries steadied balance of payments last year across our continent by borrowing from the IMF. Those loans are relatively cheap loans, low interest payments on them. And I think it's been quite effective. One saw stabilization late last year in a lot of emerging market countries in terms of their currencies and in terms of the yields on their debt. But nonetheless, the question always remains. In countries like Mauritius and some of the others that I showed on the previous chart there, which are so reliant on tourism, and it's not just the direct impact from tourism, of course, and the direct employment, it's all the multipliers and the industries that support that tourism sector. So in countries like Mauritius and South Africa, these are substantial contributions to activity. And if they don't pick up over time, one expects potential downward pressure on foreign exchange reserves and balance of payments. And of course, that's something to be aware of. Okay, so while we're on the worrying, of course, at the same time, we're back to our government response tracker, our stringency index. And you can see here in a number of countries on our continent, we still have restrictions that are significantly higher than the global average here being the blue line. So all these countries pretty much above that level, and countries like Zimbabwe back to where they were during the height of the pandemic. And this is a concern because we know that with a bit of a lag, this will impact economic activity. At the same time, though, a few countries below that level and significantly below the level that we were at the height of the pandemic. We've got Namibia, Zambia, Botswana here. Again, the blue line, the world average. And then in the case of Mauritius, substantially below. And that, I think, is an indication of the effectiveness of measures to contain the virus in Mauritius. And one can see, again, blue line, global average, and we're substantially below that. So in terms on balance, though, I think for all countries, given the fact that that base was so depressed last year, we're looking up for a bit more positive growth in 2021. Right, another reason for a bit more optimism is that now, here's a problem for economists. And the problem is we're not epidemiologists, or not all of us are. I certainly am not. And we're not vaccinologists. We're not, we are at a disadvantage. But to my eye, it does look like the mortality rate, which is the blue line, has come down substantially. It could be a question that, as measurement of the prevalence of the disease amongst people has increased, and as testing has increased, that obviously relative to the size of the population, you've got a bigger sample, and so therefore the mortality rate looks lower. I'm sure that's part of it. But it does seem like the mortality rate is at least been on a significant declining trend. It's still, of course, too high, but at least the trend in the right direction. And that hopefully means that we don't have to go down to those really stringent lockdown situations that we saw for all countries early last year. And the other thing that's particularly important is obviously your health system. So the ability of your health system to cope is also particularly important in being able to keep an economy open. And the good news here, for example, a country like Mauritius, where one has foreign tourism, a lot of tourists arriving from Europe, for example, is yes, we know there's an issue at the moment, and we know that their lockdown measures are being extended in some countries like Germany, the UK, but at least in terms of ICU patients, and this is ICU patients per million people, we've seen that peaking and starting to decline. Other countries, of course, still a problem. UK, USA standing out here, but declining in Italy, Germany, and France, or at least having looked like it's peaked, and hopefully that remains the case. Further, obviously, now looking ahead, how do you, again, economists at a disadvantage, we're not epidemiologists, but we do try and follow what they are saying, and it seems like this R0 reproductive rate is particularly important. And that's simply, as far as I can tell in layman's terms, it's the amount of people on average infected by someone who has COVID-19. So obviously you want to be below 1, because if you're infecting less than 1 person, then the disease is going to be going away. A number of countries across the globe, we are now moving below 1. You can see here Kenya, and you can see Morocco have moved below 1, but in other countries it still remains above 1. So this is a number to watch if you're a business or you're an investor within each country. If R0 starts to go below 1 and stays below 1, we've seen, unfortunately, it can go there and go back above 1, but nonetheless, it gives one more comfort if it's declining. And in some countries, we're starting to see that as well. In Mauritius's case, I know this chart looks a little bit scary because it looks like a very sharp pickup here, but just look at the axis. It stayed below 1 in Mauritius throughout the last year. And so this is particularly encouraging. And clearly, if you take this as one of the important indicators, it would suggest that COVID-19 is well contained in Mauritius, which is, of course, in the current environment, a strong advantage. Right, so we've got some restrictions being put in place, not as stringent as previously. Some countries well below the global average. We've got ICU in some number of people in ICU per million population beginning to decline. And particularly in the core of Europe, some countries still a problem, but at least in Germany, France, Italy, for example, and also in some countries are not starting to shift below 1. And these are the sort of trends that you want to see for some optimism. But of course, the game changer, and I've watched forecasters over the past few months, and it's very clear to me that the optimism for the ability of economies around the world to deliver good, decent year-on-year real GDP growth in 2021 is strongly dependent on the assumption that we're going to see the rollout of vaccines. Now, of course, when one rolls out a vaccine, one wants to see it widespread, and one wants to see it also quite clearly as quickly as possible. And here, there is maybe where the issue is for emerging markets. So what this chart is showing this data is from December, and of course it is changing all the time. But I think it's a fairly good indicator of where we are. It's from the Duke Global Health Innovation Center, and it shows the current access to COVID-19 vaccines. So the blue bars are what's been confirmed, and the orange bar is what is still potential. And one can see the countries like the US, EU, India too, UK, Canada have got very, very high levels of access. This is 1 million vaccines on the y-axis. COVAX there, of course, is going to be shared amongst a high number of countries. But the important thing then to ask is what sort of coverage do you have as percentage of your population? And that's what this chart shows. Again, Duke Global Health Innovation Center, and one can see there a lot of developed market countries have got coverage of more than 200% of their populations. Australia, New Zealand, Canada, UK, Chile, European Union generally, USA, whereas a number of emerging markets, the coverage in December, in any case, was still quite low. So countries like, on this slide here, Bangladesh, Malaysia, Thailand, Egypt, I think, most emerging markets are probably in that group. So our president, Cyril Ramaphosa, has indicated that application of a vaccine would be a game changer. I would fully agree. South Africa, for example, is looking at getting towards about 2/3 of its population this year. And I believe that that's the sort of level apparently that you need to start being confident that you're starting to contain this virus. The problem that we're going to have in the interim, though, for emerging markets is in terms of, for example, travel. If vaccination coverage is not widespread, even if foreign tourists, for example, are vaccinated, they might still feel a little bit reticent to travel because it doesn't seem, I don't know if one can expect the vaccine to be 100% effective. I don't think that's the claim. And so, there'll still be that little bit of doubt, unfortunately. So again, the importance of getting this these vaccination programs across our continent, across emerging markets, across all countries around the world, to a level where everybody is in a position to contain the virus is particularly important. Okay, so summing up, markets have rebounded. Optimism, I think that optimism is justified in terms of a better year ahead for growth. A little bit of worry, we've got incomplete recoveries, some sectors certainly struggling. That's not going to go away anytime soon. So recoveries in many cases will remain incomplete, especially in emerging markets for a while. So we've always got to bear that in mind. Now, for the investment community and for economies more generally, I spoke in the beginning, as mentioned in the beginning, what about these enduring underlying themes in the global economy? So we have these random shocks. We have COVID-19, which is a big shock to the world. We have global financial crisis, again, a very big shock. But are there underlying enduring themes that are prevailing and that are going to have for a significant period of time an impact on economies and asset prices? Yes, they are. And one of the biggest ones, of course, is the change that we've seen in monetary policy over the last few years. Very clearly, use of central bank balance sheets. And I spoke about why that was so important. But look at the impact of it. Let's just look at the US 10-year bond yield here. It's not just because of use of central bank balance sheets. That only started off the global financial crisis at the end there. And obviously, a lot of this decline in the nominal yield in US Treasury 10-year is, of course, the disinflation environment. But look at that bond yield. Even after this little recent pickup that we've seen, extraordinarily low levels. I don't have charts here to show you on global real interest rates, long-term trends, but there's been some really good work that I found on the Bank of England's website. The author is Paul Schmelzing, and he looked at 8 centuries of declines in global real interest rates and shows how over those centuries, the consistent theme has been a decline in long-term real interest rates. Yes, significant departures for extended periods of time from that for numerous reasons, but indicating that these real interest rates that we're seeing around the world at the moment are not too far off that very, very long-term trend over centuries. So that's something to bear in mind. But it's being accentuated at the moment. And of course, the reason why governments need to keep real interest rates low is to make the fiscal maths add up. We spoke about the impact of the fiscal policies that we have seen, the responses to the global financial crisis, the response to COVID-19 has left government with a lot of debt. So if you look at the case of the US, for example, look at this debt level, continuously going up. But the interesting thing there is those interest payments. If the fiscal maths is going to add up in an environment where recoveries are incomplete, long-term potential growth is not what it used to be, and you don't want to default in your debt, then you have to maintain a low real interest rate on your debt. And so this is, to my mind, a strong incentive to maintain low real interest rates. And of course, why that is important, real interest rates are the underpin for the valuation of so many financial asset prices. And that's also been part of the buoyancy of financial asset prices that we've seen for a number of years now. And okay, so I spoke about the long-term potential risk of this. So you've always got to look where that's, and economists, as I said, are always looking for the risks. One of those is that, although I say that we're on a long-term declining or have been on a long-term declining trend in real interest rates, and there's strong reason to believe that they'll remain low, I'm not particularly sure they'll remain as low as they are right now. While we have no inflation in the global system or very limited inflation, it's easy for central banks to maintain these easy monetary policy stances. But the concern is still that at some point we get something of a pickup in inflation. Now, this is a whole topic on its own, and we can talk about this all morning. So, but just the way that I see it, first of all, the long-term history of inflation, and here I've got a chart from the 13th century for inflation in England, data from the Bank of England, and it doesn't look like much. It just looks like a lot of squiggles on a chart. But essentially, right up to the last century, what we saw was in some years prices sharply up, but in some next year prices sharply down. And on average, over these 750 years, inflation in England only averaged 0.9%. So essentially, we really didn't have inflation. A lot of, I imagine, those spikes and declines were because of the heavy reliance of commodity prices those days, a lot of economic activity related to that. And we know agriculture prices, for example, very volatile, but price picks up, supply picks up, price drops. And then we went into an era where, for the first time, latter half of the last century, we had sustained positive inflation. I know it's difficult to tell in this chart because of the length of time we're looking at here, but right at the end there, if you focus there, the latter half of the last century, you'll see it remained positive significantly year after year after year. But the history of the world is for no inflation. And economists will keep on fighting about this. Some would say so much money in the system leads to inflation eventually. I don't think that that's the case. I think the only thing to worry about is that if you have a pickup in sustained inflation, that central banks don't act early enough and sufficiently enough. I don't think that's a risk at this particular point. And also at the same time, one would argue that there are other reasons why inflation could come into the system. For example, one of the most popular ones is capacity, right? And I think that there's quite a lot of evidence that when the economy is a lot weaker than its long-term trend, that you have downward pressure on inflation. And if we've got incomplete recoveries, I don't see how inflation becomes an enormous problem anytime soon. Just be aware though that some commodity prices are picking up, and that to an extent could lead to some inflation. But I don't think over the next year that this is a problem, although from a low base, just be aware that the first half of this year, we are going to see a pickup in global inflation, probably across our continent as well. And we've seen soft commodity prices go up, and we know the relatively high weight that food prices have in inflation baskets on our continent. But generally, I think that that's still the theme. The bigger worry have to start reining in on the fiscal policy front. And I think that's going to happen across the world this year. We're going to see less impetus from fiscal expansion than we saw last year. In fact, it's probably going to be a drag on activity, whereas although there is an exception is going to, I think, be the United States. But over time, in the medium to longer term, I think the debate in this year is going to be, are we going to get inflation back in the system? And I think no matter where that debate is heading, I think that concern is going to remain a little bit entrenched, that people will be concerned that at some point we could see a pickup in inflation, especially since central banks want some inflation in the system. We know the Fed would like to run inflation above 2% for a while. And in fact, it seems to be beginning to succeed with its message. If we look at inflation expectations here, so this is expectation in 5 years' time for inflation for the next 5 years from that point. So it's a very long-term forward-looking measure of inflation from the US Federal Reserve, and one can see that's picked back up to 2%. Very interestingly, from below 1% at the height of the pandemic. And the way to look at this, again, I say real interest rates are particularly important in the valuation of assets, and also very important for money flows to emerging markets. We know that emerging markets benefit when our real interest rates are higher than developed markets. And the one thing here is that this pickup in inflation expectations, which is what real interest rates are based on, is actually sharper so far than the pickup in nominal, that little blip that I showed you, pickup in nominal interest rates in the US. The rise in inflation expectations has been bigger than that. So what that actually means is that real interest rates are not going up yet. But I think as we go on through this year, there's maybe going to be more concern about inflation, and also perhaps some concern that because real interest rates are so low right now, negative in DM economies in many cases, that there'd be a pickup there, and that could cause a bit of a wobble in financial markets late in the year. But again, difficult to predict the future. Of course, the other thing that this has done is it's helped our currencies, because as those inflation expectations picked up in the US and we had these very loose monetary policies, we saw at the same time, the dollar beginning to weaken a bit late last year. And we saw the relief that brought about. Also, it in part was responsible, along with the fact that the global economy seemed to be recovering, for higher commodity prices. Again, we know there's a number of commodity producers in Africa, and oil prices picking up of late have been especially useful, I would think, for countries like Angola, Nigeria. And then, so there we are. That's the pickup in commodity prices. This is just the S&P World Commodities Industrial Metal Index.
Yeah, it's below.
Yes, I can.
We'd like to save some time for questions. So maybe if we can jump to questions within the next 5 minutes. Also, may I just ask if there's a way to make your mic louder on your side?
Okay, let's try to do that.
In this new corona world, we've got to get used to all this technical admin.
Let me see. I don't want to lose the. Okay, there we go.
Yeah.
Okay, here we go. Found the volume button. Is that a bit better?
That's a little bit better.
How's that?
Okay.
Okay. Yeah. On max now. Okay. So we got these. Okay. So I'm going to. So we've talked about commodity prices a little bit. Let's see. Okay, and real interest rates, and you can see there the low real interest rates in developed markets. And because those real interest rates are so low, that's benefited us because interest rates in emerging markets have been coming down. Now, there is, of course, an issue, and this issue is going to be in countries on the continent, and that is debt. So it's going to be pretty difficult for us to lend more fiscal support through the course of the next year. Even though global real interest rates are low, even that might attract foreign capital. A lot of our debt, of course, is in foreign currency, and we know that a number of countries on our continent have relatively high debt levels. And obviously, in terms of if your balance of payments starts coming under pressure again, and you don't have enough foreign exchange reserves, and those are falling, then that comes back into a problem in some cases in trying to service that debt. And we know which countries those are. We've seen issues in Angola, more recently Zambia as well, Mozambique, for example. Okay. So I'm going to skip a few slides here. Just be careful. Right. How to sum this up? Because I just want to finish off. If we're going to have another 5 minutes, then I'd just like to talk a bit about the US president's speech last night, and I think that's got important implications for the world and our continent. Okay. So we're in a world where we had a big smack last year, and it's been a devastating disease. We've had a bounce back supported by fiscal policy, supported by monetary policy, and optimism that we're going to bounce into this year with good growth in many countries, especially if we can get the vaccine rollout program going. Important to get that program rolled out across all countries, of course. At the same time, we've got a lot of background support, very loose DM monetary policies. Of course, as we go along, as there's some perhaps concern around inflation through the course of this year, that's going to feed back into a debate. And if real interest rates start to rise at some point in developed markets, then that could feed back into our markets. But for now, it seems like there's a significant amount of support because of our real yields and the low real yields abroad. That does attract capital and it's give us some breathing space. Also, the relatively softer dollar and higher commodity prices are also something of a boost. We need to watch in this environment, even though these global real interest rates are low, our real interest rates are still a lot higher. And the reason for that, of course, is fiscal policy, and of course the greater risk being priced into many countries across our continent, and particularly related to debt there, especially where that debt is financed with foreign currency, and especially where you have incomplete recoveries and export earning industries that are under pressure, for example, tourism. One needs to watch for that. But generally, it's not just simply because of the base, but in many cases, we have good long-term growth trends based on improving productivity and human capital development, as shown by many human capital indices, and on our continent. And you can see here from this chart, a lot of countries expected to continue to get back to their previous trends, or not quite back to them, but close to them. Yes, the recoveries are incomplete, but compared to last year, a significant improvement. I would say that areas like East Africa, West Africa is where the expectation is most, that there'd be a good rebound. The resource producers lagging, but even there, positive growth through the course of next year. The longer term trends in the resource producers haven't been as strong as elsewhere. So just to finish off then, there's so much happening in the world. There's fiscal policy, monetary policy, the implications of monetary policy abroad for us. But there are other things that are particularly important. And just to conclude, a couple of comments around President Biden's speech last night. So the way that I view the world is that for decades, we had the US leading, or at least being one of the leading countries in promoting the integration of global economic activity, promoting the integration of global trade, fair play, and all these principles. And that's been a strong driver of global economic growth as countries around the world bought into this. There's been a question mark around that in the last 4 years, very clearly. And there's been a reversal of those policies. And we've seen the trade wars erupting. And it's not just about tariffs that have been impacted. There are a lot of non-tariff barriers that have also been put up. And we've also seen changes to immigration policy. And it's been, to put it simplistically, it seems like the US was withdrawing from the world and being very unclear as to what that would leave and what would take its place. I think what we saw last night was very much a return to those principles that we'd seen. That's how I would interpret it. Whether it results in rolling back some of the measures that have been put in place on the trade front, it's difficult to tell. In some cases, it may not be the case. But I do think generally that we are probably moving into an era where we would relook at global integration, the role that global trade can play in promoting all economies. I think that is one of the more important messages that came through for me last night. It's also clear that with the president indicating issues back home, it's going to need money and spending. I think that this fiscal stimulus that the president has proposed, remember late last year we had a proposal of close to $950 billion, and now we've got $1.9 trillion. I don't think the final package will be quite as big as 1.9 trillion, but it's substantial. And so this pressure on public finance longer term is still going to be there. It's going to result in, as I say, an increase in debate. We've got to be awake as investors. Late this year, you'll probably find talk about Fed tapering against the backdrop of these issues. But nonetheless, it'll be stimulatory for the US and therefore for the global economy through the course of this year. But I think that we are returning maybe to an era where we can look for, and it'll take time to filter through to the global economy. But we probably, I would think, moving to an era where it's less confrontational on the trade front. Although I must stress, I think the US will still be very adamant that trade must be fair. And where it doesn't think that trade is fair, I think it'll still stand its ground quite firmly. Okay, I'm going to stop there. There's so much else to discuss. I was going to have a little look at, sectors around the world that are being impacted post-COVID and what that means. But let's leave it there, and let's try and answer some of your questions if I can.
Thank you, Arthur. How does that work for Mark? Do you need to pass it around? Okay. Cool. Okay, let's just try. Okay. Arthur, so thank you very much. It was very interesting. I particularly was happy that our Mauritian R note is below 1, and we're lucky to have our corona spread under control. Very interesting that Google's tracking us. I think we're all very scared of WhatsApp these days. If you move to Signal or Telegram, you're not paying, so obviously they're doing something in the data. So just think about that. But yeah, I think transparency and privacy. Transparency is the future, and privacy is over. Even privacy in terms of how we spend our money in the future is likely to be gone when all of this can be tracked. Arthur, just a question for me to kick it off, and then we'll open up to the floor. I enjoyed your slide about the Mauritian forex reserves, and I think in December it looked like it actually went up compared to November. What is Mauritian forex outlook with the reduce in tourism and the offshore sector business? How do you foresee forex in Mauritius?
Never likes is a currency one, but we do have to take a view. So we'll try. Okay, so if I look, I mean, we all know that the Mauritian rupee depreciated last year. What was interesting, it was depreciating also against a relatively softer dollar. So this was some genuine underlying weakness, and that's not surprising, given the pressure that we saw in some months on foreign exchange reserves. The trend in reserves, however, I think there is a chart there up earlier, hasn't been down. It started to shift downwards late last year, and then we had quite a bounce again in December. I'm not particularly sure what the timing was. I think there was an African, if I'm not mistaken, a disbursement from the African Development Bank that could have boosted that. But ultimately, the trend in reserves is not yet strongly down. However, I think that it's quite clear that if the tourist industry doesn't rebound, or it's probably not going to get back to its pre-COVID level for a sustained period of time. But that one could then get pressure on foreign exchange reserves through the course of this year. It's a key indicator to watch. If it does start to show a meaningful downward trend from here, then one knows that there's likely to be pressure on the currency. So how do we look at currencies? It's in small open economies that are fairly integrated with the world. One starting point that we always use is we try and calculate where's a fair value for the currency, and we use PPP. Now, I know when I say purchasing power parity, everybody's eyes glaze over and they say, oh no, there's all sorts of problems with a calculation like that. Especially the starting point, you need a year of equilibrium, for example, and that's very difficult to determine. But we don't use a particular base year. We do a best fit regression over time. And our calculation is that, and again, calculating these things, it's everybody. You've got 7 economists, you're going to have 7 different opinions on where the level is. But for us, we think that the rupee is undervalued. So and a level of closer to 33, although to pin a number on a currency is always a difficult thing to do. That doesn't mean the currency strengthens from here. And clearly the reason is the balance of payments. So until you have normalization of the balance of payments, and against a backdrop of wide twin deficits, we know large budget deficit last year, which was necessary to support in the time of COVID, large current account deficit, that's your real problem at the moment. If that doesn't correct, you could stay on a depreciating trend. But from a fundamental perspective, given the fact that for a long period of time, Mauritius' inflation rate is so well contained, also relative to its trading partners, that's normally a long-term underpin for a currency. Currencies weaken over time because one of the key reasons why currencies would weaken, and there was a chart earlier that I skipped past showing various currencies from African economies. So we saw Zambia, for example, where the currency has been on a persistent downward path. And that is about fiscal policy and worries about fiscal policy that it can't easily be fixed. And that results in inflation expectations rising. Higher inflation expectations hit currencies. So if you can maintain relatively low inflation and start to move in the right direction and start to correct those twin imbalances, then the rupee could do significantly better. So fundamentally, we think it's undervalued. But we have to make the assumption that we do see normalization of the economy over the next year, lower twin deficits, and that would be particularly helpful. So the best I can do is, that would be my view. It's just a view. Forecasting currencies is very hazardous, but we think it's undervalued. But the key indicator that you can watch on a month-by-month basis, of course, is foreign exchange reserves. If those can start to trend down meaningfully, you probably have a bit of a problem. So there we go. There's an economist giving you 2 answers.
It's hard to get a one-handed economist when it comes to currencies. Usually on the one hand, it's going to go up, on the other hand, it's going to go down. But Guys, while we're all here, what are the questions from the floor? Nitin, do you want to try from there? I don't know if we'll hear you.
That's fine, that's fine. Thank you very much for this very comprehensive expose. Nitin Pandya from United Docs.
Arthur, can you hear Nitin?
Can you hear me?
Can you hear now?
Thank you. So, Aja, my question is relating to the capital markets in Africa. We've seen you presented the S&P 500. There's been a big upswing, and apparently a big chunk of this is the tech companies. If you look at it, the Nasdaq 100 occupies a big chunk of it. So it's a lot of technology driven. But when you look at Africa, there's not much technology. Okay, there is process, there is Naspers, that's all. Okay, so what is the outlook for the African capital markets? Bear in mind that you're not in the race of technology, and how do you see it evolving, especially regarding the stock markets?
It was a little bit soft. So the gist of the question was, is it capital markets in Africa?
Yeah, exactly.
So the question was, the African markets are not really tech focused, and most of the growth in the S&P is driven by the Nasdaq and most of your high growth tech companies. Where will the growth for African countries come from, or the African continent come from, without much other than process and Naspers on the African continent? Did I capture that? No. Cool.
Yes, so obviously one has to look at it on a market by market basis. For example, so I think first of all the point about the US is particularly important. So if we look at the US equity market, we know our view is it's overvalued. And one of the ways that we look at it is we like to look at the very, very long term. So we will go back to the year 1900, for example. And why do we go back that far? Well, of course, we value investors, number one. And number two, we're trying to figure out what is we have required returns on our, for example, balanced portfolios that we require, and we look at capital markets relative to that requirement. So from 1900, you've had a depression, you've had 2 world wars, you've had a number of recessions, you've had the global financial crisis, you had the pandemic of 1918, and you had last year's pandemic, which is ongoing. So it covers a large amount of those random events that I talk about. And if you look at it on that basis, we think the US market, for example, S&P 500 is overvalued. You've mentioned tech, and that's right. So if you look at the US market, a large part of that performance is coming from the large tech companies. And looking ahead, even there, we're looking for very robust earnings growth. So the market seems to be, all in on this growth rebound being sustained and getting good, strong earnings momentum, similar to what we've seen in the past as far as the tech companies go. Now, that's not going to happen, I think, in our opinion, without investment in new activity. I don't think that can just come from trying to increase your market share. So there's a significant amount of risk there in our view that doesn't get met in such an uncertain earnings environment. And so we agree the US equity market is overvalued. And we know that historically, if the US had to turn down, and at the same time, if we are particularly in an environment where we're getting later in this year and through this year, we have these concerns building about medium to longer term inflation, and we get upward pressure on US interest rates, and we start to get, even if it's not that much, but we start to get a little bit of more talk about when's the Fed going to taper and start scaling back its balance sheet. It could result in significant volatility around the world in capital markets, including here in Africa. As I say, for emerging markets in Africa, each country is different, and one will have to look at that. But for example, if you look at emerging markets in general, we think, and you look at the tech stocks relative to those developed markets economies, we think that they would be relatively more value there, and particularly, we're looking at those in China. But if you look at the market, equity market more generally, let's look at South Africa. So on these long-term measures and based on our forward earnings estimates of the consensus, the market looks relatively cheap. And also, South Africa has underperformed in dollars relative to other emerging markets in the MSCI index. So, overall, we would be overweight South African equities, for example, in this environment, on the basis of valuation. But you're going to have to be very nimble, and you're going to have to be, I think, closely follow the debate around US interest rates in particular, as well as this year wears on, and also the Fed's balance sheet.
Thank you, Arthur. Next, please.
Good morning, Arthur. Can you hear me?
Hi, morning.
I'm J.R. Bischoff. I'm KPI Chartered Accountant. How do you explain the GDP growth of the Chinese economy? Is it not weird so quickly that they have a jump in the GDP growth like this?
Okay, so explaining the bounce back in China, I think across Asia, we've seen this. It's different countries. It depends on the amount of testing that you're doing as a percentage of the population. With a population the size of China, over 1 billion people, I think it's 1.4 billion people, to be able, testing must be a very challenging thing. But I think across Asia, it does seem like the infection rates per level of population are significantly lower, and it's been shown across Asia in lower. There are exceptions, for example, Japan of late, but across Asia, the restrictions they place on economic activity have been significantly lower than the world. And also you can see it in those Google mobility map. Well, actually, I would use Apple for that. Apple also, route requests. I was looking recently, countries like Taiwan, for example, you can see there the footfall is relatively stable compared to. So I think that they've been quite effective actually at containing the virus. And also, they have also lent a significant amount of policy support in China, both monetary and fiscal policy, which essentially is going to fade this year. They managed to get their credit cycle, up and still running and quite buoyant. That's probably going to fade again also this year, which could have implications for emerging markets more generally. But I think it's not just necessarily unique to China. It's been across Asia. From a long-term perspective, the way China's has been growing is very much they've been through a phase of capital and labor inputs, increasing capital and labor inputs. And they're now at the phase, in my opinion, where China's going to have to increasingly go through what I would call its investment phase, where it's got to absorb and distribute savings more efficiently, and then move as it moves also up the value chain for long-term maintenance of productivity. But I think a country that's maintained such productivity levels for such a long period of time, it's going to be difficult for them to maintain those productivity levels going forward. And there is also the debt backdrop as well. There's a very high level of, my final point would be, what China does, and it's done it again this time, of course, is investment spending, also led by the state, because it's had a lot of fiscal space. And that also does help when the state can spend like that directly into the economy, particularly on investment and fixed investment, because that also leads through to jobs. But China's got a very high level of capital stock and a high level of investment to output. When you've got a combination of those, normally it's quite difficult because the marginal productivity of capital is declining. And it's very difficult from there to maintain good, strong, long-term trend growth rates. So 2 points. One, not out of line with the rest of Asia. Second, a lot of direct state support, particularly on fixed investment, against the backdrop of a country that's still in that very strong growth phase that countries initially go through on their journey towards becoming larger economies.
Thank you, Arthur. And I think also with China, you've always got to be cautious around who audited those numbers. People like Jack Ma make a funny comment and then they disappear. So we're happy he resurfaced yesterday. Okay, guys, we have time for one more last question.
Hi, Alpha. Good morning. It's Mitesh Hasmal. You had an interesting chart on the GDP or debt to GDP level, which keeps going up, but the cost of the rates is fairly stable because the cost of debt has come down. If you look at it for emerging markets, you would see a similar trend historically, but I'd appreciate your comments on emerging markets. What are the risks of this going forward? Because if you look at the US or Japan or European Western economies, clearly they can take a lot more debt 2 times, 3 times today versus emerging markets. They have to be very careful in terms of how they're doing that. So I'd like to get your thoughts on that. And then the second question is Mauritius as an economy, we don't issue debt despite our investment grade rating. We don't issue debt in USD, given how deep the savings market is and how much liquidity there is. Even if we issued debt in USD today, probably wouldn't be saving that much money. But is there a case to be made that we should start to issue debt in USD as an economy? Because if you look at economies like India, they tried to do it 2 years ago and then they backtracked. So I'd like to hear your thoughts on whether we should go ahead and do it or not.
Yes, I think this is one of the key issues facing countries, and I think you make a very important point. I think the most important point is also the one that you made, and that is the development of the local capital markets. So I think, for example, in South Africa, I mean, we've got high. I mean, we know we're going above 80% of GDP in the current fiscal year, and we're probably going above 90 to 95 in the next few years. And we've got a very high real interest rate, and we know in the long term that fiscal maths is not going to work out. We're going to have to get either real growth up, or we're going to have to get real interest rates down. But what is helping us in the interim at the moment is 2 things. One is the ability of our bank system to absorb debt. So that's the first thing, because last year at one point one was concerned about how we were going to fund ourselves, but commercial banks have taken up a large share of government debt. That can't continue indefinitely. But we've got deep liquid capital markets, and that also at a time like this where you have such extraordinarily loose monetary policy in the US, it does also help because we attract a lot of capital from abroad, and that part of the attractiveness of South Africa is its deep liquid capital market. So development of the local market from those perspectives is very important, and it doesn't take a lot of the funding pressure away. It doesn't relieve a long-term problem, and the long-term problem is you've got to get your real interest rate on that debt down. And Posh, as I saw on aggregate for emerging markets, it has come down, but they remain substantially higher than developed markets abroad. The risk there, of course, is that, even though I've got an argument that real interest rates are going to remain low abroad for a sustained period, they are very, very low now relative to where we would think they should be. We think they should be low, but not as low as they are now. We're not going to guess when that correction comes, but at some point it's possible that we get something of an upward shift in real interest rates in developed markets, which would sort of argue against issuing too much debt in foreign currency at this point, in US dollars at this point, for example. So what that leaves for emerging markets, generally the more important thing here is to grow. So Kenya, for example, there's a question mark behind Kenya's debt, like there is behind South Africa's debt. But one of the things that's helping Kenya relative to South Africa is its potential to grow faster. We've all been hit by COVID, but if you look at the projections going forward, obviously significantly higher growth in Kenya than in South Africa. So South Africa has a more long-term enduring problem because of that. Emerging markets with higher real growth rates have less of a problem. So I think that one needs to be careful when issuing. There are obviously advantages in issuing a foreign debt if you issue at low real interest rate, and you can and hedge the currency impact, and you can lock in low real interest rates, for example. But from a longer term perspective, one must be cautious of the fact that you need to repay that debt in foreign currency. So if you need to be earning sufficient foreign exchange, you need to have a healthy export sector, healthy balance of payments position on the one hand. And then on the other hand, what South Africa has shown is that what is very helpful in times of crisis when that foreign capital disappears is that you need deep, well-developed local capital markets. So for me, the countries that I would look at are the countries that have managed to do that, but also have good, strong growth prospects. So those are the sort of considerations I would take into account when trying to think this through.
Thank you, Arthur. Thank you, everyone. Arthur, thanks very much for waking up early to give us that insightful presentation. We can see the sun rising on your face while we've been talking. And Mark promises that next year he'll actually bring you out in person when the flights do allow you to be here. Thanks to the Sanlam team for sorting everything out. Thank you to Catherine and Aurora for arranging today. Ahead of events coming soon, next month, we will have a presentation by Aspen on the front line of Corona by CEO of Aspen Global, Sam Kassim. You might have read that they recently did the Janssen deal, which is a global quality vaccine deal that has happened. And we've got a guy in Mauritius on the front line of this vaccine rollout who will come and share the cold face experience of what's going on with Corona. We then will have a tax update coming in March to talk about how structuring in Mauritius may be affected by the tax changes upcoming. Just a reminder, next week, Tuesday, we've got our Australia Day celebration, which will be our first joint chamber event where we aim to have the signing of our MOU for the International Chamber of Commerce in Mauritius, which will be a new initiative that Graham is leading, along with myself as a founder member and the American Chamber of Commerce, which will be a collective voice of the chambers in Mauritius to the regulatory bodies and the wider authorities in Mauritius. We also aim to launch our Gala Night this year. The Gala Night will be a night where we can celebrate and recognize the achievements of our various members in Mauritius. So we'll hear more about that. There'll be a nominations process and a judging committee and all of that set up. And of course, no chamber year will be complete without a few fun socials. So we aim to have 1 or 2 fun socials over some wine and beer over the next few months. So we look forward to seeing all of you there. Thank you very much for your kind attention. Cheers, guys.